Millions of Americans just received a letter that could determine how much Social Security they'll get for the rest of their lives. And most have no idea what it actually means. The Social Security Administration is quietly sending out benefit estimates. And if you misunderstand or ignore this letter, you could miss out on thousands of dollars in retirement income. The worst part? You might not even know you made a mistake until it's too late. If you're over 50 and planning to rely on Social Security, hit that subscribe button right now. Every week, new changes, silent rule updates, and missed opportunities are slipping past millions of Americans, but not here. On this channel, you stay ahead. And in today's video, we're breaking down a letter that just went out to millions. And one wrong move could cost you over $180,000 in lost benefits. So subscribe now and protect what you've worked your whole life for. Why this letter is so important and why it's arriving now. In early April 2025, the Social Security Administration, SSA, began sending letters to millions of Americans. But this isn't just another government notice. This letter contains a personalized estimate of your future retirement benefits. It's designed to help you plan, but if you ignore it or misunderstand what it really means, the financial consequences could follow you for the rest of your life. This move by the SSA isn't random. With growing concerns over the long-term solvency of Social Security and the sharp rise in retirement age Americans, the agency is pushing harder than ever to ensure people understand their benefits early. According to SSA data, over 40% of retirees rely on Social Security for 90% or more of their income. That makes these letters not just helpful, they're potentially life-changing. But here's the catch. Most people don't read them carefully. They glance at the estimated monthly benefit and toss it aside. That's a dangerous mistake. These estimates are based on your reported earnings history, and any error, no matter how small, can reduce your monthly income for decades. In fact, according to a 2023 audit by the Office of the Inspector General, 1 in 5 Social Security statements contained inaccurate earnings data. You may not have asked for this letter, but what's inside could help you avoid one of the biggest financial mistakes of your life. Especially now, as inflation chips away at retirement savings, healthcare costs continue to rise, and economic volatility increases. Every dollar matters. The timing of this letter isn't just a formality, it's a signal, a warning, and possibly an opportunity. What's inside the letter, and what most people? Miss the letter from the Social Security Administration might look simple at first glance, but behind those numbers lies a roadmap that could shape your financial future. Inside, you'll find a projected monthly benefit based on your current earnings, an estimate of what you'll receive if you retire at different ages, and a summary of your lifetime income as reported to the SSA. Seems straightforward, right? But this is where most people make a critical mistake. They assume the numbers are final, accurate, and personalized down to the last detail. They're not. What many don't realize is that the projections assume you'll continue earning the same income until retirement. So if you're planning to retire early, change jobs, reduce hours, or face an unexpected career disruption, the estimate could be wildly inaccurate. For example, if you're 58 and planning to stop working at 62, but the letter assumes you'll work until 67, the benefit estimate will be higher than what you'll actually receive. That's how people end up retiring with far less than they expected. Even more alarming, if there's an error in your earnings record, a missing job, an incorrect wage, or a year where income was never reported, it directly impacts your benefit calculation. And unless you catch it, it won't be fixed. According to SSA reports, errors in earnings history are surprisingly common, especially among self-employed workers or those who changed employers frequently. It's not enough to look at the letter. You need to understand what it's really telling you, and more importantly, what it's not. Because failing to read between the lines could cost you thousands each year in lost benefits. And in retirement, you don't get a second chance to correct that. The $182,000 mistake. Why one wrong assumption could cost you a fortune. One simple assumption, made by millions of Americans every year, could cost you over $182,000 in lifetime Social Security income. And the worst part? It often starts with that letter you just received. Let's break it down. The benefit estimate in your Social Security letter is typically based on the assumption that you'll claim your benefits at full retirement age. For most people, that's between 66 and 67. But if you claim earlier, say at age 62, your monthly benefit could be reduced by up to 30% for the rest of your life. On the flip side, delaying until age 70 can increase your benefit by as much as 32%. Now consider this. According to the SSA, the average American collects benefits for 18 to 20 years in retirement. If you claim too early and miss out on even $700 per month, that adds up to over $150,000 in lost income. Add in cost of living adjustments and the opportunity cost of that extra money, and you're easily looking at more than $182,000. But here's where the mistake happens. People see the number on the letter, assume it's the full amount they'll receive, and plan their retirement around it. They don't factor in their actual retirement date, life expectancy, taxes, inflation, or spousal benefits. They just go with the number on the page and lock in a lower benefit for life. This isn't just about math, it's about peace of mind. A decision made in haste, based on incomplete information, can create decades of financial strain. Especially in a time when more Americans are living into their 80s and 90s, you simply can't afford to leave this money on the table. How to verify? If your earnings are recorded accurately, this might surprise you. Your Social Security benefits are calculated based on your 35 highest earning years. But if even one of those years is missing or incorrect in the SSA's records, your monthly benefit could shrink by hundreds of dollars. And once you start collecting, it's almost impossible to go back and fix it. That's why verifying your earnings history is one of the most critical steps you can take after receiving the Social Security letter. First, look for the Your Earnings Record section. It shows the amount you earned each year that was reported to the SSA. You should compare these figures with your tax returns, W-2s, or pay stubs, especially in years when you changed jobs, were self-employed, or experienced gaps in income. According to a study by the Social Security Advisory Board, more than 10% of records have some kind of discrepancy, and most people never realize it until it's too late. That could mean a year of income is missing entirely, or significantly underreported, reducing your final benefit calculation. If you spot an error, the good news is it's fixable, but only if you act before you apply for benefits. You'll need to contact the SSA and provide documentation like a W-2, 1099, or other proof of income. Without this step, your benefits could be permanently reduced simply because of a paperwork issue from 10 or 20 years ago. Warren Buffett once said, "The chains of habit are too light to be felt until they are too heavy to be broken." The same applies here. These small mistakes feel invisible now, but in retirement, they can become heavy burdens. Check your earnings history carefully. No one else will do it for you. What Warren Buffett would do with this letter. Warren Buffett isn't just one of the richest men in the world, he's also one of the most disciplined. And when it comes to money, he doesn't rely on assumptions. He studies the details, asks the right questions, and makes decisions with long-term impact in mind. If Buffett received this Social Security letter today, he wouldn't glance at it and throw it in a drawer. He'd treat it like a financial X-ray and analyze every number. The first thing Buffett would likely do is compare the earnings report line by line, looking for discrepancies. Why? Because he knows compound impact works both ways. Just as one smart investment can grow massively over time, one error in your earnings history, even a small one, can compound into tens of thousands lost over a retirement span. He'd also consider the value of waiting. Buffett has always emphasized patience. He once said, "The stock market is a device for transferring money from the impatient to the patient." The same principle applies here. Claiming Social Security early might seem appealing, but why? But for someone thinking long-term, delaying benefits often leads to a significantly higher lifetime payout. Buffett would run the numbers, weigh the pros and cons, and avoid rushing into a decision driven by fear or convenience. Finally, he'd likely look beyond the benefit amount and ask, "What does this tell me about my larger retirement plan?" He wouldn't see the letter in isolation. He'd fit it into a broader strategy: tax planning, investment diversification, and income longevity. Buffett doesn't chase quick wins. he prepares for the decades ahead. And that's exactly how you should treat this letter, not as a notice, but as a powerful planning tool, because what you do with it today could shape your financial freedom for the next 30 years. When and how to claim, and why timing is everything. There's a hidden decision in that Social Security letter, and it's not the number you see. It's when you choose to claim your benefits. That choice can mean the difference between struggling financially or living with confidence for the next 20 or 30 years. Most people don't realize this. The Social Security system is designed to penalize early claims and reward patience. If you start collecting at age 62, your benefits could be reduced by up to 30% permanently. But if you wait until age 70, your monthly payment can grow by 8% each year past full retirement age. That's a 76% difference between claiming early versus waiting until 70. The Social Security letter shows what your benefits might look like, but it often assumes you'll claim at full retirement age and doesn't explain the long-term consequences of claiming too soon. That's where many people go wrong. They see the number, feel confident, and file too early without factoring in life expectancy, inflation, taxes, or spousal benefits. Let's look at a common scenario. Say you're entitled to $2,000 a month at full retirement age. If you claim at 62, you'll get about $1,400. But if you wait until 70, it could jump to around $2,480. That's an extra $1,080 per month, or over $12,000 per year for life. Timing doesn't just affect you. If you're married, your decision impacts your spouse's survivor benefits as well. One misstep today could reduce the income your partner depends on later. Think like an investor. As Warren Buffett says, time is the friend of the wonderful business. In this case, time is the friend of the patient retiree. Don't rush the decision. Know your options, understand the impact, and claim with clarity, not convenience. 3 critical actions you should take right. Now, you've received the letter, you've seen the numbers, but none of that matters unless you take action now. Social Security isn't something you can afford to approach passively. Your retirement security depends on what you do with the information in front of you. These are the 3 most important steps to take immediately if you want to protect and potentially increase your lifetime benefits. Review your earnings history thoroughly. Don't assume it's correct. Go year by year. Compare the earnings listed in your Social Security letter to your tax returns or W-2s. A missing year, or even a single underreported figure, can lower your benefit for the rest of your life. If something doesn't match, contact the SSA and submit proof. You only get one chance to claim your full entitlement. Strategize your claiming age based on your life situation. Don't fall into the trap of claiming early just because you're eligible. Consider your health, family longevity, financial needs, and whether you plan to keep working. The longer you delay, up to age 70, the more your monthly benefit grows. This decision affects not just your income, but your spouse's survivor benefits too. Make it part of a long-term plan, not a short-term reaction. Integrate Social Security into a broader retirement strategy. This letter isn't a standalone document. It's a piece of a much bigger puzzle. Use it to guide conversations with a financial advisor. Review how your benefits will be taxed. Plan how they'll fit with your 401k, IRA withdrawals, and other income sources. Warren Buffett's success isn't based on luck. It's built on seeing the full picture. Your retirement should be no different. You can't control the economy, you can't control what Congress does to Social Security, but you can control how informed and prepared you are, and that starts with this letter and what you choose to do next. Don't wait until it's too late. Every month, new rules are quietly changing how much Social Security you'll actually get, and most people won't find out until the check hits their account. If you don't want to be one of them, subscribe to the channel now, because the next video might be the one that protects your retirement or helps you unlock thousands you didn't know you were missing.